Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Profitability Index Explained, a simple guide for smarter investment decisions. Determining the discount rate. Once you have the cash flow data, the next step is figuring out the discount rate. The discount rate represents the cost of money, or the level of risk you're willing to accept for this investment. But how do you choose the right one? It depends on several factors. Cost of capital. If you're financing the project through loans or equity, the interest rate or return expectations set the baseline. Risk level. Higher risk investments often require a higher discount rate. If the project feels unpredictable, factor that in. Market conditions. Economic factors like inflation or market volatility can influence the rate you select. In many cases, businesses use their weighted average cost of capital, WACC, as the discount rate. For personal investments, you might use something simpler, like the expected rate of return from alternative opportunities. The key is balance. Choose a rate high enough to reflect actual risks but not so high it discounts future cash flows unrealistically. Performing the calculation. Now that you have cash flow data and a discount rate, it's time to calculate. Let's break it down with an example. Imagine you're considering an investment with these details. Initial investment, $50,000. Expected cash inflows, $20,000. Year 1, $30,000. Year 2, $10,000. Year 3. Discount rate, 10%. Here's how you'd calculate the pie. Discount each cash inflow to its present value, PV. Use this formula for each year. PV equals future cash flow divided by 1 plus discount rate, number of years. Year 1. $20,000 divided by 1 plus 0.10, 1 equals $18,181.82. Year 2. $30,000 divided by 1 plus 0.10, squared equals $24,793.39. Year 3. $10,000 divided by 1 plus 0.10, cubed equals $7,513.15. Apply the pie formula. Pi equals total present value of cash flows divided by initial investment. Pi equals $50,488.36 divided by $50,000 equals 1.01. This pi of 1.01 means you're expected to earn $1.01 for every $1 you invest. While not a massive return, it suggests the project will at least break even. Key takeaways for the calculation process. Always use consistent time periods, e.g., yearly, quarterly, for cash flows and discounting. Use a realistic discount rate to avoid skewed results. Double-check your math. An error in one step can cascade through the entire calculation process. By carefully following these steps, you'll reduce guesswork and make confident, data-driven investment decisions. Interpreting Profitability Index results. Understanding the results of the Profitability Index, PI, is essential for making smart investment decisions. PI helps you gauge whether a potential investment will add value or waste resources. Below, we'll break down what different PI values mean and explore how businesses rely on PI for better decision-making. Understanding PI values. PI values can be grouped into simple categories that indicate whether an investment is worth pursuing. Here's how to interpret them. PI greater than 1. This value signals a green light. It means the investment is expected to generate more benefits than its costs. For instance, if the PI is 1.25, you'll gain $1.25 in value for every $1 invested. These projects are typically attractive and worth further consideration. PI equals 1. A PI equal to 1 suggests the investment breaks even. The benefits and costs are equal, meaning the project neither adds nor subtracts value. While this isn't inherently bad, it may not be ideal when compared to other projects with higher PIs. PI less than 1. A value under 1 is a warning sign. Here, the investment is expected to produce less value than it costs. For example, a PI of 0.8 implies you'll only get 80 cents back for every dollar spent, a clear indication to think twice. This simple categorization makes pie easy to use in real life. It helps investors avoid bad opportunities while identifying the most rewarding ones. Real-world applications of pie. How is pie actually used? Businesses and investors incorporate this metric into their decision-making processes in various ways, prioritizing projects with limited budgets. Companies often face a tough reality: limited funds and too many investment opportunities. Pie offers a straightforward way to rank projects based on efficiency. For example, if a company has $1 million to invest across multiple proposals, they'll prioritize projects with the highest pie, ensuring every dollar spent delivers the greatest return. Evaluating long-term projects. Pie is especially helpful for long-term investments, such as infrastructure projects, product launches, or real estate ventures. Since it factors in the time value of money, businesses can more accurately assess which projects will create sustained value over time. Comparing projects with different scales. Not all investments require the same financial commitment. Pie levels the playing field by focusing on efficiency rather than raw dollar figures. A small project with a pie of 1.3 might be a better choice than a massive project with a pie of 1.1. Assessing strategic initiatives. When deciding between strategic investments, e.g., entering a new market or updating a product line, pie provides clarity. Companies can compare diverse projects with inconsistent cash flows by calculating their pie and understanding each investment's potential value. Reassessing existing investments. Pie doesn't have to be limited to new opportunities, it can also evaluate ongoing projects. By recalculating the pie based on updated cash flow forecasts, companies can decide whether to continue, expand, or terminate a project. In real-world practice, pie acts as a compass, pointing organizations toward financial decisions that maximize value. Whether it's ranking projects, comparing options, or reassessing past decisions, the pie provides a clear, quantifiable framework for action. Combined with other metrics, it leads to smarter, more confident investment choices. Limitations of Profitability Index. While the Profitability Index, PI, is a useful tool, it's not without its flaws. Depending solely on pie can lead to missteps in decision-making. This section looks at common limitations of pie and why they matter. Sensitivity to cash flow estimates. Pie relies heavily on cash flow estimates, but these numbers aren't always reliable. Why? Because predicting future cash flows is tricky. Market conditions shift, customer behavior changes, and unexpected expenses pop up. Imagine basing a decision on projections that turn out to be too optimistic. If the actual cash flows fall short, the calculated pie becomes meaningless. It's like planning a road trip with a poorly drawn map. You could end up far off course. Here's how inaccurate estimates can skew results. Overstating future cash inflows leads to overestimating pie, making unwise projects appear profitable. Underestimating costs inflates pie calculations, painting an overly rosy picture. Ignoring external risks. Factors like economic downturns or new competitors can throw off values. To avoid these pitfalls, use conservative and well-researched numbers. Double-check assumptions, rely on historical data, and adjust for risks. Ignoring non-financial factors. Numbers don't tell the whole story. While pie highlights financial efficiency, it completely ignores qualitative factors that may be just as important. Think about sustainability, employee well-being, or brand reputation. These can have long-term impacts that pie simply doesn't measure. For example, a project with a high pie might harm the environment or alienate customers. Another project with a lower pie might strengthen community ties or improve team morale. Sometimes, strategic goals go beyond profits. Expanding into a new market might not have an impressive pie up front, but it could open doors for future growth. Similarly, projects supporting innovation or social responsibility might not score high on pie but still align with broader organizational goals. In short, pie is a helpful calculator, but it's not a crystal ball. Pair it with qualitative analysis to get a fuller picture of an investment's worth. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.